Good morning, and thank you everyone for joining us for our second Brodies Banking and Finance Academy session. My name's Lindsay Lee, and I'm the Practice Development Lawyer in the Brodies Banking and Finance team, and I'm joined here today by two colleagues from that team, Ewan Wallace and Thomas Horton. And today we're going to talk to you about the UK government COVID loan schemes. So the UK government COVID loan schemes were introduced to support UK businesses that were suffering lost revenue and cash flow disruptions as a result of the coronavirus outbreak. And the whole aim and the whole thrust of the schemes was to give those businesses quick access to finance. Today's webinar is well timed because some of the earliest loans that were taken out last year are now falling due for repayment. So we're very much moving into the next stage in the life cycle of these funding facilities. For those of you who are joining us today from scheme accredited lenders, you might possibly have been involved in the negotiation or the origination of those loans, and there'll be other members of your business, other teams that are now primed and ready for the recovery and collections activities on those loans. So what we're talking about today are some very live issues. Now, the government coronavirus support package obviously went well beyond the coronavirus loan schemes, but today what we're going to look at are the different loan schemes to the extent that they're now relevant at where we are now in the life cycle of the loans, how the loan schemes differ from standard commercial loans or facilities, how the government guarantee works, intercreditor implications where the borrower has existing indebtedness, issues around recoveries under the loans, and industry issues around the loans. And then at the end, we'll have time for some questions. If you've got any questions you would like to put to us, please use the question and answer function. And if you could leave your name with your question, that gives us the chance to get back to you directly afterwards if we don't have time to get to your question in today's session. So without further ado, I will pass you over to Thomas, who's going to give us a talk through the different coronavirus loan schemes.
Thanks very much, Lindsay. So before I briefly touch on a few of the schemes and a few of the higher profile ones, just wanted to actually stick up a couple of quotes there. So first one from the Chancellor and second from the Prime Minister in a press conference of 17th March 2020, just when they were announcing a number of the schemes. And I think the key thing to take from those quotes here is actually probably the last line of Boris Johnson's one there. So we will do whatever it takes. And I think it was noted at the time that was quite a pointed and intentional use of a similar phrase, which had been successfully used by European central bankers in 2012 when allaying the significant Eurozone crisis. Obviously, the third slide on the third bullet point on the slide there is just an indication, an initial 330 billion with a B in loans pledged with additional support and top-ups thereafter. So next up on the screen here, I've got a few lenses with probably the most well-known schemes. And I think what I should first say is that the first four of them, so the schemes up there with the exception of the recovery loan scheme, those schemes have actually now closed to new applications, but certainly were very topical at the time. And so I'll just run through a few headlines on each of them. So the first one there, the coronavirus business interruption loan scheme. And that was actually launched in the immediate aftermath of that 17th March press conference. And that was aimed at small and medium-sized businesses with a turnover of less than £45 million. And there, the amounts being lent ranged from £50,001 up to £5 million with a term of up to 6 years, depending on the type of financing. So 3 years for overdrafts and invoice financing facilities and 6 years for loans and asset finance facilities. Now, a bit of kind of update here is that those terms could be extended in some limited situations, but Lindsay's going to touch on those a wee bit later on. A key hallmark of the CBIL scheme was the government guarantee. And so there, 80% of the finance was guaranteed by the government to the lender. And Ewan's going to touch on that government guarantee point in a little bit later on as well. But also another key thing, the government paid all fees and interest for the first 12 months of that loan. Got a quick asterisk there about the personal guarantee. So for facilities below £250,000, the lender was not able to take a personal guarantee. Above that, so £250,000 and £1, the lender had discretion whether to take that or not. Now, final figures are being calculated, but it's estimated around about £23 billion was lent to just under 100,000 applicants. Next lens there is the coronavirus large business interruption loan scheme. And I won't spend too much time here because that was very similar to the CBIL scheme, except for large businesses, so for those with a turnover of over £45 million. Here, businesses could access loans for up to 25% of their annual turnover, up to a value of £200 million, with terms ranging from 3 months to 3 years. Here, an estimated 5.3 billion was lent to just over 700 applicants. Next one on the screen, we've got, it's probably the least well-known of the 5 on the screen, the COVID-19 corporate financing facility. And this was quite a specialist scheme, whereby the Bank of England bought short-term debt from large investment-grade companies and was strictly available to companies which made a material contribution to the UK economy. Their estimates are that just over £37 billion was lent to just over 100 different companies, with the Bank of England estimating that eligible CCFF companies involved in the scheme accounted for around about 2.5 million jobs. So very much ticking that material contribution to the UK economy point. We've next got the Bounce Back Loan Scheme. That's probably the most well-known, I would say, out of the schemes, and certainly the most well-subscribed. And that was launched actually in April, so a little bit after the CBIL scheme, just to address a few delays and things which they were perceived in the CBIL scheme. Largely along the same lines as the CBIL scheme, but there the government guarantee was 100% rather than 80%. But other aspects pretty closely mirrored CBILs, but in relation to smaller amounts. So for example, borrowers were able to borrow between £2,000 and up to 25% of annual turnover, up to a figure of £50,000. Now here, the payment reprofile changed slightly in February 2021 to allow for things like interest-only payments and term extensions, but Ewan's going to touch on that a little bit in a minute. But I think a key hallmark of the Bounce Back Loan Scheme was that companies were able to access it more than once, provided that they hadn't been able to access the full amount that they were entitled to. So you could go back up to the maximum amount. Current estimates here, as I say, probably the most well subscribed. So just under £47 billion lent to just over 1.5 million applicants. And then quickly covering off the last of the schemes on the slide there is the Recovery Loan Scheme, which is actually the newest scheme launched in April of this year, with applications due to close in December of this coming year. This was actually is available to help businesses of any size, but we go back to the 80% government guarantee down from the 100% on the BBLS. I think critically here, businesses which have received support from the other government-backed schemes are again able to access this finance, provided that they meet other eligibility criteria. Here we've got term loans or overdrafts of between £25,001 and £10 million, or asset finance facilities of between £1,000 and £10 million, depending on the business. Terms here of up to 3 years for overdrafts and invoice financing facilities, and up to 6 years for the loans and asset finance facilities. And I think we'll then move on to passing over to Ewan, who will discuss the differences between standard commercial facilities.
Thanks, Thomas. Broadly speaking, there isn't a huge amount of difference in the terms of normal commercial loans and the government-backed CBILs, or indeed the recovery loans. They can all be on the lender's standard terms, and they're negotiated or not in the usual way. The government, the guarantee aspect doesn't come into the documentation, so there's substantial differences around the terms required for scheme compliance and any accompanying documentary requirements. The bounce back loans are slightly stricter. They have a fixed interest rate of 2.5%. The terms are fixed for the duration, and the documentation is slightly more prescribed. Now, rather than run through the specifics of each scheme, we thought it would be better to talk about the common aspects across the schemes which differ from normal commercial loans and which we think are going to be most relevant going forward. The first of these points of difference is that under these schemes, there's lending which would not otherwise be viable. Under CBILS and CLBILS, recovery loans and bounce back loans, the borrower has to show that they've been negatively impacted by coronavirus. They also have to be not classed as a business or undertaking in difficulty. For CBILS and CLBILS, each borrower must have provided a proposal which the lender would have considered viable were it not for the COVID pandemic, which the lender believes will enable the borrower to trade out of any short to medium term difficulty. Now, this creates the slightly odd situation where, in order to qualify for the loans, the borrower will have needed to show that they would not otherwise have qualified for a loan. Now, because of the loose nature of some of the guidance, it's likely that there will be issues going forward with borrowers who would not have access to the scheme, would not have had access to the scheme, either because the impact of COVID wasn't as damaging to their business as expected, or as stated in their application, or probably more concern that they would have failed as a business even without COVID. It can be expected that the government and lenders will be more concerned with the latter than the former, and it's really not clear where we'll land on how the government will approach this when it comes to paying out on the guarantees. This also links in with the issue of fraud, which Thomas will touch on. It should be said that it looks like the recovery loans will be policed slightly more strictly, and the hope is that the guidance on that will be more in depth and so mitigate possible issues around the recovery loans on this point. There is also some new regulations in the pipeline on investigating dissolved companies, which is thought have recovery loans in mind. The next point of difference is that these schemes are government schemes and are therefore subject to the whims of government. They have a basis in government regulations and as such can be changed by the UK government. As an example of this, on 8th February, the Treasury announced more options for bounce back loans for borrowers. These are on screen. This is in addition to the pay-as-you-grow options, which have also been rolled out. None of these points were built into the initial documentation, and these may not be the last updates to the schemes to be pushed through. All we can really say here is watch this space. We'll need to wait to find out how the government will adapt these schemes for the next phase of the pandemic. The third point of difference is the government guarantee, which I'll look at on its own. Now, I'm sure you're all aware of the levels of the government guarantee offered under the various schemes. I've noted them again on screen just in case. Accredited lenders under all of the COVID loans have overarching umbrella agreements with the government guaranteeing the loans they advance, rather than having separate guarantees for each loan. It's worth flagging that interest is dealt with differently across the schemes, which will become increasingly relevant as interest will now be payable on some of the loans for the first time, but likely won't be covered by the guarantee. So what happens if the guarantee is called on? As yet, we are not very certain on that. We're not aware of any of the guarantees being claimed against yet, which means that there is a good bit of uncertainty around how that process will play out in practice. There's a quote on screen which hints at where there might be issues around this, as the usual process of calling up a guarantee is part and parcel of the enforcement process, whereas here it will be somewhat disaggregated. Indeed, it will probably come at the end of the enforcement process. So how is it supposed to work? Firstly, lenders are required to pursue an appropriate recovery process in line with their existing standards under the terms of the guarantee. Lenders have a 12-month time limit, after which they have issued a formal demand on the borrower to pursue outstanding amounts. Claiming on the guarantee is not conditional having completed the recoveries process, and lenders are able to make a claim on the guarantee within a reasonable time period following the first formal demand date, or sooner if lenders believe no further payment is likely. It's worth noting that any recoveries under the guarantee will be net of any recoveries made by the lender. The recovery process has been agreed with lenders on a principal level, and HM Treasury were expecting to agree specific operational details by the end of this winter. Now, to our knowledge, these terms haven't been formally agreed yet, though the suggestion is that they will be similar to the approach adopted for recovery under the Enterprise Finance Guarantee Loan Scheme. Although that's not certain as yet. We also don't know what the impact will be, if any, on lenders failing to have fully interrogated the but for COVID viability of the loans. It's certainly not without the realms of possibility that this or a future government decides to be more stringent in checking the lender's documentation in reliance on what may have obviously been wrong statements on current financial standing of a borrower and the impact COVID had on them. So in summary, on the guarantees, we'll have to wait a bit. We have some idea on how they will work, but we will need to wait and see what happens when they're actually called on. As the others will touch on, that might not be for another few months. To finish off on my part, I thought I would give a few observations around intercreditor agreements and how they're working under these schemes. As a reminder on ranking, CL Bills facilities must rank at least pari passu with the borrower's most senior obligations, subject to certain carve-outs. These ranking requirements don't apply to any of the other schemes. I'll take you through a quick canter through the headlines of what we are seeing in the market and the potential issues arising around ranking and intercreditors. The first point which we would note is that lenders appear to be a bit more relaxed around ranking generally. This certainly isn't a rule, but for the most part it is. Where security is sought, first ranking security is not always sought. Though obviously for CL bills, it must be at least pari passu. What constitutes normal market standards around ranking has moved somewhat as well in relation to these loans, presumably to allow the COVID loans to be provided more timeously, or simply to allow the COVID loans to be provided at all. I think, simply put, insisting on first ranking security in the circumstances of a potentially distressed borrower may scupper some deals, and so lenders have adapted their market standard approach to that. The second point I'd like to talk about is companies that have previously only had shareholder debt or equity and would otherwise not have been seeking bank debt, are having to take up these loans, and so are having to get up to speed quickly with the requirements and approach of commercial lenders. This is often proven to be challenging in terms of getting them up to speed and getting them on board with what is required, especially given the truncated timelines for these types of transactions. The last point I'll talk about is that we have seen some issues arising around lenders who are already providing debt and in some cases already have security. And how that operates with the COVID loan scheme. This is particularly the case where existing security either wouldn't cover the full debt or was granted in support of a personal guarantee. We haven't yet seen how this will play out in practice and whether lenders may end up restricted on what they can recover under security in their favour, possibly contrary to the terms of that security, because of how it relates to the requirements of the COVID loans and the restrictions around personal guarantees and what can be secured. On that note, I think I can hand over to Lindsay to talk more about recoveries.
Thanks, Ewan. So in this section, I was going to look at the proposals that have been made to deal with the economic knock-on effects of such a large number of businesses carrying such high levels of debt, and also looking at what lenders can do to recover monies due. So Thomas drew out nicely the scale of the lending that's taken place under the schemes. And here on this slide, I'm just particularly in the bottom three lenses, I'm highlighting the scale of the anticipated defaults and losses. So in July 2020, the Office for Budget Responsibility estimated that 40% of bounce back loan borrowers might default, and that at that stage compared with an estimate of 10% each for C-bills and CL bills. Just a couple of months later, the National Audit Office's report highlighted continuing uncertainty around the bounce back losses, and subject to some fairly heavy caveats, it put the potential risk at anywhere between 35% and 60% of borrowers defaulting. And then also at the tail end of last year, the City UK's recapitalisation group estimated that between 20 and 23 billion of unsustainable business debt was expected to stem from all UK government guaranteed lending schemes. So we are dealing with an unusually high number of expected losses and defaults here. Rolling back a little bit to debt in itself, high levels of debt are problematic because they do become a drag on growth and investment and wages. Economic recovery gets delayed because businesses are understandably focusing instead on repairing their balance sheets. And this is something that the Treasury Committee drew out back in its report in September of last year, where it pointed out that viable SMEs that were struggling with debt will prolong the recession, and it called upon the government to develop solutions to ensure the recapitalisation of the balance sheets of those viable SMEs that were struggling. So various potential solutions have been put forward from different quarters, and they essentially distill down into four main approaches. There's obviously permutations on each of those, but broadly they are as follows and as shown on the slide. So forbearance we've already seen taking place in relation to the pay-as-you-grow options for the bounce back loan with payment holidays, interest-free periods, loan extensions, and we've also seen it in the C-bills loan extension from 6 to 10 years. Forbearance tools generally work quite effectively for firms that are facing a temporary liquidity crisis or have temporary liquidity issues, not so well designed for firms that are facing a real risk of insolvency. Also, the drawback with these measures is that they have a tendency to increase the number of so-called zombie firms. So those are firms that carry so much debt that their profits only just cover their debt interest payments, and that on an economic scale recovery pathway is not helpful in the medium and long term. Then there's a debt forgiveness program approach, and that is based on the idea that at some point you might be simply better off to write the debts off. And advocates for that approach take the view that writing off the debt, particularly for small businesses, would give a much needed boost for the SME sector. It would enable a speedier economic recovery, more growth, more investment. And in the long term, that should benefit the taxpayer overall. From a lender perspective, a debt forgiveness program avoids the use of costly debt recovery agencies, whether those are centralized or not, and we'll come to that shortly. And it also takes out that potential litigation or complaints around mistreatment of borrower SMEs, which is an issue which we have seen in the past. Advocates for these types of programs include George Osborne in his evidence to the Treasury, and also the Association of Accounting Technicians, who advocated it in relation to the 100% guaranteed bounce back loans. Third approach there is the debt for equity swaps, and there has been discussion about the possibility of the government taking equity stakes and reducing the debts of smaller businesses. It's largely been viewed that this won't work very well for very small businesses, but larger businesses, it could possibly be undertaken on an industry-wide pre-agreed basis. Again, with uniform conversion parameters, lenders should, or the government, there should be an avoidance of any criticism for the way in which the conversion is carried out. And then finally, there's a contingent tax liability approach, which works rather like the student debts, student loans, in the sense that if you do well and you had a loan, you'll be asked to pay quite a lot back, and if you don't, then you won't. And the advocates of that approach include the City UK report on recapitalisation and also the conservative think tank Onward. So each of these approaches or permutations of them would require some form of long-term management or oversight. And ways of dealing that have been put forward include setting up a bad bank structure. So a bad bank's an entity which is usually underwritten by the government and to which you transfer bad loans, which are weighing down on the lender's balance sheets. And they are then wound down over time. It has its advantages for lenders as it would take the matter off their hands, but our understanding is that at this stage, the government doesn't have the detailed and accurate data it needs to take that proposal forward. Alternatively, or in addition, there's also the possibility of setting up a new state or investment or development bank. So development banks are used around the world to help drive investment, and the UK already has the British Business Bank, but if it were to be charged with dealing with each of the, or one of the approaches we've outlined above, that would involve an expansion to its scope and purpose. So lots of different proposals have been put forward. The government itself hasn't yet expressed its intentions for what it's going to, or how it's going to deal with the potential losses, but it has been pretty clear that it's taken the view that it's the accredited lenders and not the government that are best placed to support borrowers in their repayment of the government guaranteed loans. So for now, at least, the proposals that we've just looked at are off the table, but depending on how things play out in the recovery of the debts and in whether the estimates of the defaults and losses bring true, and we could see those elements reconsidered. So for example, when we see more detailed data, perhaps the bad bank proposal could be revisited. So what the lenders do have is a code of conduct. The government worked closely with UK Finance and the scheme accredited lenders to develop a consistent and industry-wide approach to the collection and recovery of the loans. That guidance has now been shared with the accredited lenders, and from a lender perspective, the real benefit of that is that it should avoid any complaints about the way a particular lender is pursuing a debt gaining any traction if they are following the industry guidance. Next, FCA handbook and FCA guidance. So just to bear in mind that if you are collecting debts from a borrower who is a sole trader or a small partnership, that could be a regulated activity, and therefore the FCA handbook rules could apply. So in particular, think about Conc 7 and Principle 6, which is the treating customers fairly principle. In addition to that, the FCA issued in January of this year guidance which explains how the FCA handbook rules apply to the pay-as-you-grow options for the bounce back loan scheme. And the key messages in that guidance very much echo the ethos that underlines the FCA handbook rules. So it's the importance of treating customers fairly, supporting vulnerable customers, giving borrowers the ability, or customers the ability, to opt out of automated journeys, offers of additional forbearance, and making sure that you have effective and strong oversight of third-party debt collection agencies. So lastly, just in this section, personal guarantees. I know Ewan's talked about these, and Thomas is going to touch on them again. But just a reminder that for CBILS facilities over £250,000, personal guarantees can be taken, but no recovery action can be taken over the principal private residence. And recoveries under the personal guarantee itself are capped at 20% of the outstanding balance on the CBILS facility after the proceeds of business assets have been applied. Lastly, but for bounce back loans, obviously personal guarantees can't be taken, and also no recovery action can be taken over a principal private residence or a primary personal vehicle. So there are restrictions on the recovery action that lenders can take in respect of these facilities. And on that, I'm going to pass you over to Thomas, who is going to talk to us about some more general industry issues affecting the schemes.
Thanks very much, Lindsay. So yes, just want to kind of have a quick canter through what we've been seeing in terms of clients and what we see as kind of wider industry issues before we then move on to some any potential questions that you might have. So again, I've put up here a few different industry issues that we're seeing in terms of the wider schemes, and again, won't dwell too much on them, but just wanted to highlight them as to what we're seeing. So the first one being delays in implementation. So obviously, as I mentioned, a lot of the government schemes are now closed, so we won't spend too long here. But I think certainly the quote up there from Paul Yakubian was quite an interesting one, in that I think there was a perception that some of the initial delays with the scheme was down to the fact that banks needed to assess how to take the 20% risk on their balance sheet, so the 20% over and above the government guarantee. And then I think also whether to lend to borrowers on the commercial terms or under the COVID schemes. And Ewan mentioned that striking that fine balance for viability for businesses. As well as that, I think a key plank of the government's wishes was that for facilities above £250,000, the lender had to establish a lack or absence of available collateral from their borrowers before before the borrowers were able to access the schemes. And while this was quite an admirable plank of it, probably to ensure that businesses without collateral, and so those arguably in greatest need for help from the government schemes, benefited from it, what it actually did was added another criteria separate from a business's viability and whether or not there was available collateral there. Certainly, linking back to what Lindsay was saying about personal guarantees and personal assets, many small and medium-sized businesses, the available collateral was in personal assets of the owners of those businesses. And so while the schemes were intended to support otherwise viable businesses that were being ruined by the pandemic, I think a significant portion of those businesses were actually being cut out of the schemes by way of the fact that the owners of those businesses had built up personal assets. So while those successful SME businesses could then, in theory, borrow from the bank and they would then arguably be in a more vulnerable position due to the fact that they had granted security, so personal guarantees and security over assets, than arguably the less successful businesses without the collateral and which were eligible for the government-backed schemes. I think probably the biggest issue that is potentially coming down the track very quickly is that of fraud. And I've put up a couple of quotes there. So the first being from Gareth Davis, the Comptroller of the Auditor General, when he was speaking to a Treasury Select Committee in April 2021. And I think the key thing to flag there was obviously what he's saying there, a conscious weakening of control. And I think what he was noting there was that well-established controls weren't able to operate quite in the same way that they were pre-pandemic. So things like dealing with provenance of claims, that became a bit more difficult. And certainly the National Audit Office actually particularly name-checked the Bounce Back Loan Scheme as being quite problematic in that, given it was launched in the immediate aftermath of the CBIL scheme against a perception of some slightly slow implementation of it, the Bounce Back Loan Scheme was operating in quite a heated market with very high demand. And what this ended up doing was probably the removal of some credit checks and affordability checks that would ordinarily have been carried out were the loans being taken out in more normal times. And certainly, I think Mr. Davis also noted in terms of the government end that liaison between the different departments there was patchy at best, to use his wording, such that checks on whether companies had received loans from different schemes before receiving from another weren't really being carried out at the government end between the different government departments. Certainly, I think that the second quote there, the one from Angela Eagle, kind of really highlights the extent of the issue, that there was a perception that ne'er-do-wells could be taking advantage of the system. Now, certainly, I think we're starting to see repayments in the schemes now starting to fall due. And while the Chancellor allowed some companies in the form of forbearance, which Lindsay touched on, to defer repayment dates and things, the picture on the extent of fraud, we think, will probably be teased out over the coming months. But certainly for lender clients, I think the key thing is to look for which borrowers have started making their repayments or which have started a dialogue with you in order to extend repayment dates or repayment terms. And then certainly the Treasury and lenders themselves will get a bit of a better picture as to the extent of the fraud point. I think probably the next one I wanted to touch on was just in terms of the effect on facility documentation. And Ewan touched on that a little bit earlier on. But I think what we've been noticing certainly is, probably as was the case pre-pandemic, the level of amendment and negotiation on the government-backed schemes depended tended to be higher depending on the higher value of the loan. But certainly what we've been seeing is provisions being built into facility documentation, updating existing wording and definition around things like existing indebtedness, existing creditors. Certainly Ewan mentioned the ranking provisions in Intercreditors, and obviously the pari passu for CL bills, and then perhaps a bit of an acknowledgement from the banks in relation to existing lending on other transactions. And certainly we've been noticing lenders being a lot more flexible on things like near-term activities. So, for example, funding being pre-consented, future funding being pre-consented, and equity cures for things like covenant breach, alongside amendments to representations and warranties to take account of COVID. I think a key example here being material adverse change, and such that that's been caveated in facilities to note that there has been no material adverse change other than where such adverse change can be has been caused solely by the impacts of COVID-19. Just touching really quickly on the security position, because as again, Ewan and Lindsay have touched on it pretty briefly, but I think what we've been finding is that a firm position hasn't really been landed on, I don't think, and we're seeing different approaches from different lenders. Certainly on the personal guarantee position, Lindsay flagged obviously the thresholds there of below £250,000 no personal guarantee, above that lender discretion. But a freedom of information request from Purbeck Personal Guarantee Insurance found that about £2.1 billion of CBILS loans were secured by way of a guarantee. Now there, the average guarantee, the average loan, in a personal guarantee backed CBILS loan was just over £70,000, and so given that 20% threshold, guarantors could be liable to pay up to close to £150,000 should the guarantee be enforced. And certainly on the position on existing all sum security, we've been seeing it hasn't really been tested, and certainly speaking to insolvency practitioners, accountants, etc., I think that's probably coming down the track pretty quickly. So very much one to watch the space, I think. And then I think finally, before we move on to some any questions you might have, just wanted to really quickly touch on the repayment of loans. Now, Lindsay covered that in the context of recoveries, but I think what we wanted to flag here was just obviously the fact that the first tranche of COVID support loans are now falling due, but I think the issue is being slightly complicated by other planks of the government's support, which they announced last year. For example, giving businesses the opportunity to defer tax on things like income tax, VAT bills. Now, while a lot of those bills should have been repaid by now, I think a lot of them haven't. And so many businesses are behind in those payments. Now, HM Revenue and Customs have so far taken quite a lenient approach in this. But what they have noted from July onwards is that they are intending to start to issue winding up petitions against those companies that haven't paid their tax bills. So arguably demands for repayment on the government-backed loan schemes are coming probably at the worst possible time for companies. But I think just to summarize it all in terms of that, I think what we would say is from the lender side, lenders have been keen to engage, keen to show solidarity and engage with their borrowers. And I think certainly what we've been finding is those lenders which start a dialogue pretty early with their borrowers have been the most successful in reaching an amicable solution. So I think what we would encourage any lenders on the call is just to start that dialogue early. Oftentimes, a lot of the potential issues can be mitigated in a pretty straightforward way. You know, Lindsay mentioned the forbearance, etc. And we've been noticing borrowers that have been engaging early and amending things like repayment dates have been able to sort that relatively quickly and relatively painlessly. So I think I'll then hand back to Lindsay, who will then open up the floor to any questions.
Thanks, Thomas. I have got a question here which actually touches on some things that I talked about and also some things that Ewan talked about, and it's a good one. The question is whether there's enough of an incentive on lenders to recover from borrowers before they claim under the guarantee. Now, I know that this was something that was highlighted in the National Audit Office's report in, I think, October last year, particularly in relation to bounce back loans, where it was clearly stated that because of the 100% guarantee, there was it could certainly be said that there was a weakened incentive on lenders. But Ewan, what are your thoughts on that?
Yeah, I think that's right. The bounce back loan is probably the one where there is at least a decent argument that there's not enough of an incentive on lenders to recover. Obviously, not trying isn't an option, but how much you have to try is debatable. I think inevitably 100% guarantee in the background will reduce the incentive somewhat, especially when after the 12-month from initial demand. I think on the other ones, I think the 80% guarantee probably automatically means there's more of an incentive to recover, and I think because you're trying to recover under that, the way that recoveries are taking place, the chances are that you're going to be going after more than just that 20%. So I think it is mostly focused on the bounce back loan. I think it's something that will be looked at going forward, and I think the recovery loans will probably pick up on it. I think the one big caveat on that though is the optics of it. I think throughout this, I think that lenders are going to be keen to avoid enforcement action, and so they'll be looking at, as Thomas said, they'll be looking at other ways so they don't have to get to that stage. So although there might not be the incentive, there's a good argument at least that the incentive is to not get to that stage rather than to have to recover under the loan.
Okay, thanks, Ewan. Question, it's a crystal ball question here for you, Thomas, and on top of that, I'm going to give you about a minute just because I'm conscious of time. You have highlighted a whole variety of issues facing those involved in the loan schemes. What about looking forward? How do you see things playing out in the next, say, 3 to 6 months, very quickly?
Yeah, so I think you mentioned the crystal ball. So kind of getting that out, I think probably in the shorter term, it's probably quite hard to say, given we don't have a huge amount of reliable data so far. It's probably not going to be available until later this year or early next. But I think the perception certainly that we've been hearing on the market is that there's potential of a bit of a cliff edge coming, really in terms of repayments anyway, because certainly obviously the repayments are now falling due. Some might not be made, and I think we touched on there with the government guarantee, there's the potential of the government having to start absorbing some of this debt by way of the government guarantees, as well as for things like the deferred rates and taxes. I think obviously conscious of not too long an answer, but things like other government schemes ending, so furlough is tapering down, and that could obviously cause issues, and as well as the recent announcements on Monday and Tuesday from Boris Johnson and Nicola Sturgeon about an extension to lockdown. So things like the hospitality and leisure sector are obviously going to continue to be have a very hard time, and that's probably going to, I think, probably play out in the autumn going forward. Certainly, I think there's probably a bit of a crunch point coming, probably September, October, as we're coming out of lockdown. I think there's a perception that we might not actually see some results of that until maybe early in the coming year, sorry, so 2022.
Thank you, and thanks for keeping it so brief. I'm sure you could talk an awful lot more about that. Everyone, that concludes today's Banking and Finance Academy session. We hope you enjoyed the presentations and also the discussion. If there's anything you would like to pick up with us further on anything we've talked about, please do get in touch. Thank you very much for joining us, and from all of us, please take care and goodbye.